little bit of a coffee chat and go over what it is that's going on in the mortgage market so we can understand how to best serve our clients and have the latest information at our fingertips. So I'm going to bring on Jerome here, and we're going to have a quick chat. If you've got any questions, just put them in the chat box, and we're happy to answer your questions as we go if we can. And let's get into it. Jerome. Hey, Jerome. How's it going?
Great. Morning, Jethro. Happy to see you.
You too. You too. Hopefully you had a nice Thanksgiving weekend and you're ready for the fall market. It's the last section of the fall market from my perspective. We wind up doing a bunch of deals between now and probably mid-November, and then things sort of taper off. So you're probably going to be busy over the next little while.
Remarkably, we're having calls all weekend, and in fact, this morning we have team members that are entering brand new mortgage files. So the market is still very robust.
Oh, good. Well, last week there were apparently a bit of a rate increase, and so what we were hoping to do is maybe get a little bit of an understanding as to what the recent mortgage hike was from TD and CIBC, and if there were any other lenders that also did that kind of mortgage increase.
Basically, we saw lenders across the board increase their 5-year fixed, which is the most commonly quoted mortgage product we have, but they all pretty much went up by 25 basis points. So let's say the interest rates were on a typical 5-year fixed around 2.09, they then increased about 2.34%, or in that range.
And that 2.34, that I guess 25 basis point increase sort of translates into how much when it comes to sort of affordability?
So on a monthly basis, it will negatively impact your cash flow by about 3%, meaning it'll increase your monthly mortgage payment by approximately 3%.
Okay, and yeah, that could be significant for some people, so they gotta keep that in mind for sure.
Oh yeah.
Do you have an idea as to what might have triggered the banks to increase their rates like this?
Mm-hmm. It's the borrowing cost, and that's established by the market. So the commercial bond yields have all increased over the last little while, and then the banks, the lenders, have to pass that on to clients. So as the commercial yield goes up, so do the borrowing costs. Hence, that's why we're seeing slightly higher interest rates, and they're probably going to be going in this direction for quite some time.
Right. And yeah, well, that's what everybody's concerned about, I guess, with inflation as well as the bond yields going up. And there's a bit of a disconnect, I guess, from the bond yields and the prime rate that the Feds put out and what the variable rate is in comparison to that fixed rate.
You're right, Jethro. Oftentimes we hear people saying, oh, the government's not going to allow this to happen, or the government won't allow that to happen. What people don't understand is the government is directly involved in variable rate products by establishing the Bank of Canada overnight lending rate. On the other side, it's the market, the commercial bond market, that actually sets the fixed mortgage rates. So that's the disconnect between the two. The government is involved in the variable product, and it's really the market that sets the 5-year fixed.
Gotcha. Well, that's good to know. And well, I've got the crawler running across the bottom here to give people sort of what the current rates are, but we can get into that in a minute as well. So generally, like when the bond yield increases, what does it mean for the economy and in general, and the interest in mortgage applicants? Like, how's that going to affect people over the next, say, 3 to 6 months?
What we're seeing, Jethro, is the impact of inflation coming into the borrowing equation, and that's being passed on to the typical consumer. So as we see inflation kicking up, that will be passed on into the borrowing costs as well. So it gets built in or baked into that rate.
Yeah, it's gonna be tough for people. I guess if we have a number of hikes over the next little while, and that inflation number, the Feds were saying that it wasn't really going to impact, but it clearly is. We've seen it in house prices, gas prices. I know I filled up this week, and it was pretty substantial. I think it's like $1.80 a liter now, something or close to that. So it's quite a bit. Yeah. So I guess one of the things we could talk about this on another show, but one of the things that people in houses already have often as a mortgage, or if they're stepping up, to another mortgage, they're going to have in and out costs, and there's all kinds of different products, I guess, that work with existing mortgages. And how do you manage that if you're trying to buy up or change your existing mortgage?
I think if we step back a little bit, we take a look and see what the 5-year fixed was like just before COVID started. We were putting most clients into a 5-year fixed right around 3.5%. And at the time, Jethro, that was a very competitive market.
Right.
Anyway, through a number of factors, we've seen interest rates drop to never seen lows. And really, we should expect to see the 5-year fixed come back to that 3.5% range. And it's a very natural progression. People should not assume that they're going to be able to get a 5-year fixed at 2% in perpetuity. Anyway, so what should you do if you're in an existing one and you think, well, if you're of the same mindset as I am, and I don't see how they can't go up with inflation increasing, then this is the time you should be locking in some protection for yourself. So if you have any sort of consumer debts, you have a renovation, if you're looking to buy a second home, if you're looking to do a major purchase or acquisition or take on more debt, this is a time to secure it at the low rate.
Right. Well, let's talk about that a little bit. What are I know I have the crawler along the bottom with the current low rates, but there's obviously a whole bunch of different options for people out there. The current fixed rate is 2.34 to 2.49. And I guess that has some caveats to it, as everything in life does.
You're totally right. We do have lower advertised rates, but such a small number of people actually qualify for the incredibly low advertised rate. We're just more comfortable putting out something that's a bit more realistic. 95% of our clients, they want to talk to us about a refinance or a purchase of a property north of $1 million. You're going to have a slightly increased mortgage rate. Hence, that's the 2.34 to 2.49.
Gotcha. And that 2.09 rate, like what would you have to do to qualify for something like that?
Well, in those instances, Jethro, and all lenders do this, they all advertise their insured rate. So if you're putting down less than 20% and you incur that, we'll call it the CMHC premium or the insurer premium, that's how you're going to get the lower rate. However, by the time you add in that insurance premium, let's say it's a $500,000 purchase, you're putting down 5%, you're paying a 4% insurance premium that gets added to your mortgage. So it's almost a little bit misleading your sticker price. Your actual borrowing cost because of the insurance is much higher.
Yeah, and that'll sort of eat into whatever your affordability.
Correct. The other side of the equation, Jethro, particularly with your clients, it's hard for people to buy a house in Midtown under $1 million. So anything north of $1 million, that can't be an insured purchase. It has to be what we call uninsured.
Right.
So, and those rates are a little bit higher.
And you need a minimum of 20% down in that event.
All of the lenders use it's a gradual scale on what they'll provide on the loan to value. For instance, on a $5 million house, which 10 years ago was very abnormal, in Midtown today, it's not that uncommon, but we don't have any lender that's going to go 80% loan to value on the whole 5 million. They'll go, for instance, 80% on the first 2 million, and every million after that, the amount that they lend, the loan to value, it actually drops.
Right. Well, with the rates as low as they are, what do you think this will do to the fall housing market as it stands right now? I don't know. I know we only have probably about a month to 6 weeks left in the fall housing market. Then it's going to dry up a little bit over the holidays and come back in late January. But for the next month or so, what do you think is going to happen here?
I do think we're going to see some increases in interest rates over the next 6 to 12 months. Will we see those in the next 30 to 60 days? I don't know. A lot's going to unfold in the US economy, and that's really what drives the commercial bond market. Is it really going to impact us? Coincidentally, because we're using an inflated Bank of Canada qualifying rate of 5.25, it's not going to impact how much people can actually qualify for in the mortgage front. What it's actually going to do, just like the other impact of inflation, you mentioning you're going to get a gas at $1.80 a liter, that's taking away how much money you have available at the end of the week or at the end of the month. And that's ultimately what's going to be the impact of these higher interest rates.
Yeah, for sure. For sure. Yeah, I've been following, this is a little off topic, but I've been following a news story out in overseas in China with something called Evergrande. And they seem to be defaulting a little bit on some of their bonds, but it seems to be their foreign bonds that they're defaulting on mostly. But that's a big market over there. Is that kind of thing? Do you see that having any impact on our local market? I know it's far away, but the numbers are big and it's a big economy. So I don't know.
It's interesting you're bringing this up. The European market is watching this closely, and this is more a macroeconomic discussion. I'm really not that well educated or suited to discuss it, but don't kid yourself. They're such a large player. Their bond offerings are in so many different markets. It will impact the capital markets globally, and there is a good chance that we'll feel that here.
Gotcha. Wow. Okay. Well, we'll see. We'll see how it all unfolds, and I guess that'll be over the next couple months. I know they've got some other payments, and I'm following it a little bit closely too. See what happens. But more locally, I guess there's going to be a number of deals that are going to happen, and if you've got any advice for interested home buyers on what to expect in the coming months.
Well, the fundamentals are still so incredibly strong, Jethro, in terms of supply and demand, that our real estate market is appearing to be in fantastic shape as far as being able to withstand any price pressures. Do we want to see prices go higher? Of course not. However, as we see the brand new to Canada applicants, and we're starting to see more of those come across our desk, that is what ultimately is driving up the demand within the GTA and really all of Southern Ontario. So as the federal government ramps up those initiatives, those applicants, those new to Canada people that are being allowed to come in and settle in the area, they're very well qualified. For the most part, they're either well educated, affluent, have some sort of financial backing, and that's how they're able to advance themselves on the federal government scoring system and how they get in. Anyway, that demographic is used to living in multi-unit dwellings, condos, and quite frankly, we've had such a lack of that demographic over the last 12 to 18 months. Basically, when COVID started, the new to Canada applicants that we were dealing with dried up overnight.
Right.
Well, they're now starting to come back as the federal government is truly trying to push that mandate to have, what is it, I think 400,000 people within Canada in the next 12 months. They're declaring we'll have well over 100,000 new people. And as I say, Jethro, these are not blue collar, unqualified people. These are well-educated, home buyers.
Well, that's a big part of the market. That's certainly going to have a push overall. Yeah, that's what we're seeing in the Midtown residential market as well, not just the condos. The condos are a little bit softer than the housing market right now, but it's not soft. It's just softer.
Yes.
So that's going to be part of having so many people come to the city, which is a good thing over time. But it certainly makes affordability issues a bit prevalent. It's good to have smart, hardworking people in Toronto, and I think that'll help the city overall. But housing prices continue to go up, and we're seeing a lot of multiple offers out there. So, you need good representation both on the mortgage side as well as on the real estate side, so you can get things done and get deals done. So, yeah, it's a challenging market, but we can get it done. We do a lot of deals, so it's good to be able to work with someone like you, Jerome, and make sure that my clients are able to get the information that they need in order to do a deal. And sometimes we have to go into offers without conditions, and one of those conditions is obviously the financing condition. So I appreciate all your insights and all your hard work, and hopefully we can do this again and talk about some other areas like debt service ratios and maybe some immigration issues, and see how that's going to impact the market in depth. I want to say thanks, man. Thanks for coming on a Tuesday morning after a long weekend. I know it's probably a bit.
My pleasure, Jethro. Thank you very much for having me, and enjoy this beautiful day.
All right, you too, man. Take care.
Okay. Bye-bye.
Bye. All right, everyone. I just want to say thanks for taking a look here and having joining us for our conversation. If there's any information that you want about mortgages specifically or the real estate market, feel free to reach out to us, and we'll be able to supply any information that you need. Thanks again, and have a fantastic week.